Hello, everyone. Now let us look into equity cost of capital. Now, as we have discussed so far, the cost of capital has at least two main components, cost of debt and the cost of equity. And the overall cost of capital, or the weighted average cost of capital, can be represented mathematically this way. So this initial part here is the weighted cost of debt after tax. That's what 1 minus T is corporate tax, plus the weight of equity times cost of equity capital. Now, so far we have discussed how to find cost of debt by finding the market value of that debt first, if that is available, and then trying to find the yield to maturity. And that gives us the cost of debt. But the tricky part is how do we find the cost of equity so that we can find the overall cost of capital? And cost of equity now, by definition, is the minimum required rate of return to persuade investors to either buy the company's shares or to hold on to those shares. And this cost of equity capital can be a very useful metric to find share prices and to find the value of the firm as well. So let's try to break the cost of equity down into two components first. One is the risk-free rate, and then the additional reward you take. Now, starting with the risk-free rate, what is it? A risk-free rate, it's something you can earn as an investor without taking too much risks or without taking too much uncertainty. Think of a government bond where you can invest and where you are pretty much certain how much you are going to get in return every year if you invest in long-term government bonds, for example, UK government bonds or US Treasury in the long term. And you are not going to lose your money because you can be assured that the government will pay you back, and the return you get will be very much similar or stable over depending on what you have invested in. So that is risk-free, very stable earnings. So that's risk-free. So when you invest in equity, there's more uncertainty. So you should not be satisfied with the risk-free rate because you are taking on more risk, right? So as an investor, equity investors would be seeking additional reward on top of the risk-free rate. And when talking about that additional reward, you could say there are some risks that are diversifiable and some risks in red here, which are not diversifiable. Now, talking about diversifiable risk, imagine as an investor, you have a chance to invest in a company that produces umbrella that is useful in rainy season, and a company that produces ice cream, which is useful during sunny periods. If it rains very heavily in a given year, the umbrella company might do well, but the ice cream company might not do so well, and vice versa. So as an investor, by investing in both of these companies, you have diversified your risk. And you will not be seeking additional rewards for this diversifiable risk because that can be managed. However, there are risks in the market that cannot be diversified. For example, if there's a recession that is going to impact all the companies. And that is the risk, the systematic risk the equity shareholders would want additional reward, additional premium for, because they are taking this extra risk beyond the risk-free rate. And that helps us to find the cost of equity, because on top of the risk-free rate, the equity shareholders demand return for the risks that cannot be diversified. So only that component of the additional risk that cannot be diversified. And capital asset pricing model is a very popular technique in finance that helps us find the cost of capital, equity capital. But before going any further, there are many assumptions to simplify the calculation. And some of the assumptions are listed here. As you can see, investors are assumed to seek maximum return for a given level of risk when they invest. And there are no transaction costs or taxes. And the investors will not simply invest in one or two companies, but they will invest in the world market portfolio, meaning they will invest proportionally in all available investment opportunities. And the expectations regarding market return are similar. And then information is available to everyone. So those are some of the assumptions that underlie capital asset pricing model. And the formula itself is very simple. As you can see, Rn, that's the required rate of return for an asset N, for a company N, for example, is given, or the required rate of return on equity capital of company N is given by RF, that's risk-free rate. Now, that is something you could have earned by investing in government bonds as an investor. But since you are investing in this company, this business, you want additional return on only that part of the risk that cannot be diversified. So this is the formula. Beta, that measures the sensitivity of the returns of this company N compared to the market. And in the brackets, you have RM, that's expected market return. Take away the risk-free rate again. So that gives you the return on equity capital required by the shareholders. And how do you get beta? So that is, again, just to repeat, the sensitivity of the returns of this company compared to the market. And the formula for that is covariance of the market return and this asset. So that shows you the co-movement, that's covariance, divided by the volatility of the market. So that's variance of the market. And that allows us to calculate beta for this company N. And once we have beta, once we know the risk-free rate, once we know the expected market return, then we can find the equity cost of capital for this company. So some of the denominations are shown here. For example, this is correlation, Sharpe ratio, which are related. So variance of the return, that's variance. Standard deviation of risk is the square root of variance, market return, and so on. And now, let me go back to the previous slide. By using this simple formula derived from capital asset pricing model, we can figure out the required rate of return on equity for a given company in this very simple manner. Now, there's one thing I want to mention here. Capital asset pricing model is a very popular technique, but this is not the one and only technique to find cost of equity capital. There are other ways of finding equity cost of capital. For example, you could use the dividend growth model, for which I will be uploading a separate video. And it's also a very simple technique, but I will be uploading another video on that. So it should suffice to say that there are more than one ways of finding equity cost of capital, depending on what kind of information we have. So I'll stop here. Speak to you soon.